Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty. I hope you're doing well. I am going to be doing two housing market updates. Usually we do one a week, but there's so much going on this week and so much I wanted to get caught up on from the last week or so that I thought it'd be good to kind of do a couple of really good mashups this week because tomorrow the Fed starts to meet, and then by Friday we have a new jobs report that comes out. So here's a quick summary of what's going on up to this point, what we're kind of seeing across the country and here in the greater Phoenix area. And then we'll kind of break this down a little bit more. And then, like I said, I'm going to do another one of these later in the week once we know where we're at on the jobs report, just so that we have some more of that data. But mortgage rates, as far as mortgage rates, we see that 57% of mortgage holders rates are under 4%, and 18% have rates under 5%. Um, we're even seeing a start of a kind of a, I wouldn't call it a boom, but an increase in refis. A lot of people who maybe have bought over the last year and a half or so, they're seeing that they can actually get better rates right now for a refinance. So people who bought with like FHA or VA, reach out to us. We can put you in touch with a great mortgage broker that we refer clients to. And if you've got something that's over, let's say 6.5 for those government type loans, be worth looking into. Again, even if you're looking at a 1/4% decrease, it'd be worth looking at the numbers, breaking it down. I know, whenever I've had that in the past for myself, definitely we've looked at refinancing, especially when those rates were super low in those anomaly years. We had refinanced, I can't remember how many times. So, anyway, take a look at that. If you got a conventional loan, you may want to look at something, if you were maybe over seven, look at that and kind of see what you can refinance there. But anyways, we see that debt to income ratios, new home buyers ratios are at a high of 40%, matching levels seen in 2006. Ooh, the crash years. There's no crash happening, guys. I'll explain again for the millionth time why. But despite stricter lending, there is a shift happening though. There are actually two shifts. Okay, we'll get into that. But despite stricter lending practices right now, since 2006, higher debt to income ratios are impacting affordability, and I think that's just a matter of the economy, right? Everybody you talk to, it's like everything's gone up. Uh, people's insurances have gone up, 25, 50% or doubled. Uh, you know, uh, people's electric bills, trying to force you into doing solar and all these different things. And then there's the solar, depending on the company and who set it up, really saving you money. Keep hearing these stories over and over, how much people are spending at the grocery store, at the gas pump. And, although the rate of inflation has come down, the overall really impact of the peaks that we had and the ongoing price of energy and things like that are really impacting the whole market. And when you really look at how they used to, um, figure inflation, which I think is a lot more accurate because you're figuring in a lot more factors that people are really dealing with day to day, not necessarily what the Fed looks at, but what's happening there is really a lot more, probably double or more the numbers that we saw. The way people are feeling that now. There are wage increases every year and things like that, sure, but are they really keeping up? And then you've got the deal with the how the dollar has taken a hit. So a lot of factors there. But inventory and prices. Let's take a look at inventory prices. Unsold, again, this is across the country. Unsold home inventory has increased 38% year over year. Again, and this kind of goes to the whole idea of, are we going to be in a crash? Are we not? Significant rises in states like Florida and Texas. The median home price is around 450,000. The same time last year, while nearly the same as the last time last year, while home sales are selling for just under $400,000 on average. Okay. So that's median versus average. Price cuts are more common, with about 38 to 40% of homes experience price reductions. Okay. We're seeing a lot of that across the country right now, in the Phoenix area. Um, again, it's not a crash, it's just kind of a slight adjustment. Prices, home sales are kind of flattened. In order to have a crash, just think about that, guys. You've got to really look at the last 2 or 3 years and the way home prices have gone up, really over the last 12 years. And what would constitute a crash? You'd have to really look at you know going way down. So when we have price adjustments, maybe a different uh, bump in the road with where we are in the current economic conditions, the current sales that are number of sales that are going on and all that. And a lot of it obviously has to do, yeah, people would say price, of course, but really more of the impact is really in interest rates. We've proven that because every time we've had little shifts here and there, we see a bounce with home sales. Now, in order to keep that, interest rates and future outlook, we're looking at, wanting to be sub six, really, sustained. If you really want to see a huge impact, we need to get rates back, between 450 or 4.5, I'm sorry, 4.5 and, maybe upwards around 5.75, 5.8 in that range for a sustained period of time, not these little bounces and then, the economy is all over the place like it has been, or the inflation rate, or, unemployment and the Fed's numbers, and, keeping these rates so high for such a long period of time has obviously affected it, and, and it slowed things down, which was their objective. But we see, over and over again, people are like, even other Fed members are starting to speak out. Ex-Fed presidents are starting to speak out, which I'll show you here in a sec. And we're seeing, this trend going on. So, recession and inflation. If a recession occurs, oh wait, before I get into that, construction permits are down, but you know, as they pick up, they may help balance the market later on once they start picking up. There's no indication of a housing crash. Like I said, price adjustments are kind of anticipated with moderate changes there. The biggest thing that we're going to be looking for unemployment is, you know, again, every recession kind of kicks off with construction, people in construction, because, once they're losing their jobs, and there's not as many projects for them to be involved in, and usually these projects take months. I mean, like for instance, if we're looking at, we've talked about this before, like these apartment complexes or these big rental, communities, they take up to 21 months. So, those things kind of have a lag period on those. But once those single family homes and those multifamily homes projects are done, that's going to be the huge indicator. And we think we're pretty much getting there. Every indicator is that we're getting there, because you got to remember, construction is kind of the beginning of the housing, giving it more inventory. But as that slows, the permit slows, and there's less work, and there's less people, a less product out there for people to choose from. There's a little bit less maybe in sales activity. So then we have this, repercussion through the whole market, right? People are not only not buying homes, not getting loans, all those sorts of things, but they're not, going down to the Home Depot and the furniture store and buying all these different things, and it kind of, all the stuff that you would buy for owning a home or starting a family, which, first time home buyers right now, they're making up over 30% of the market, which is huge. And they're being hit by affordability, but they may be starting off with more of a starter home. They're getting these buy down programs that builders and sellers are offering right now, which are great. So you can get lower rates right now. Please reach out to us so we can kind of explain how that works. There's all kinds of things that, not necessarily for a first-time home buyer, probably, but there's assumable loans. There's, uh, seller financing that can be another option. There's a lot of different options out there that we can look into and get you into to actually get lower than what you're seeing and what, the average rate that they're showing on the news out there. I mean, we've got people in the brand new homes, resale homes with these buy down rates that sellers and builders have to pay for, okay, or are paying for with the concessions because things are just slower and they want to get their property sold. So, we're seeing people get, rates, in the mid threes to low fours for the first year. Second year goes up a little bit. Third year it goes up a little bit more, but then stays there, and it's lower than what people are paying at now. So as rates continue to now shift, where we're seeing that, the Fed is going to be lowering the Fed's fund rate, which will drop the mortgage rate, along with these, other things that are going to be factoring in. And, if you're thinking about, well, I'm going to wait till September, then when they lower these rates, well, then you're kind of behind the eight ball, really, because this stuff, like we've got these lower rates already this week, already baked in. So, when we talk about these things, all these kind of indicators are already baked into the market that we're looking at. So let me go ahead, and I'm going to actually share my screen here with you. Let me just, this thing just went haywire on me. Okay, let me show you where we're at here. Okay, hopefully you can see that. The Federal Reserve meets this week, July 30th, 31st. That's going to be tomorrow. Um, this week's job report could trigger a usually reliable recession indicator, which whenever there's a recession, housing does well. Why? Because rates drop. So we're right on that cusp, guys. And if you try to time the market, then you're going to get hit with all the extra demand, the extra competition, and less concessions, less closing costs paid for, less of these buy down programs, will then gradually go away as the demand increases the other way. So it's just something, it's not a way to get people to do stuff now and be all, salesy. It's just a way to kind of inform people now we are in this shift where these rates are going to start dropping. As they drop, you want to be ahead of that. And right now would be being ahead of that. If you close on a property, let's say in 30 days, think about this, let's say you close on a property in August. Um, you're not going to have your first mortgage payment till October, okay? Or if you close in September, you're not going to have your first mortgage payment till November. So by that time, we're already getting deeper into this lower, rates and everything. You can always refinance later. As a matter of fact, when you get these buy down programs that we can help again with brand new, move-in ready, brand new, already built, ready to go homes, or homes you're going to have, built. Usually, sometimes they're offering them on those too, but definitely the ones that you can move into right away within the next, say, now or 30 or 60 days, 90 days ahead, or with resale homes. And the seller and the builders not only pay for that, but that money sits in an escrow account. So now not only do you not have to refinance later on when the rates drop more to with no out-of-pocket costs, but there's no cost at all. It's not even rolled into the loan because that money is still in the escrow account. And guess what? It's already paid for you by the seller, by the builder, and now that money can be put into this refinance. Okay, so just something to think about. I'd rather gain equity in the home I want to be in, also if you're a seller, than the home I'm in now if I want to move. So that's something else to think about rather than waiting to sell. I think we're going to see this bounce back and this gradual decline in rates, and now would be the time to buy or list the property and move on. So there's a lot of different options there, but the key takeaways is we're looking at this what they call the sham rule. Okay, it's an indicator reading of 0.5% or more in any given month signals that the unemployment rate is rising fast enough to warn that a recession is coming. Okay. Or has it already started? And we're already seeing this softening in the labor market. The labor data that came out last month was put us at about 4.1%. I mean, that pretty much set alarm bells off. So the indicator to watch for the Bureau of Labor Statistics payroll report for July, due this Friday, is the unemployment rate. If it rises to 4.2%, from its July level of 4.1, it would set off recession alarm bells. And most people feel like that's what's going to happen. So at that point, again, we're going to see before the Fed, if the Fed doesn't do anything this week as far as lowering the Fed's fund rate, which affects the bond market and then mortgage rates, then, because it's basically run off the 10-year yield. And we're already seeing less of a split in the numbers between that yield and the mortgage rates, which is automatically going to bake in better numbers once they do lower it. But then with these unemployment numbers, we're going to see that the bond market's already going to react to that. So if those numbers are there for the unemployment, not that we're rooting for people to lose jobs, but that's just what to look for. Okay, guys, that's just where we're headed. That's the trend. This is past President Eric Rosengren. He says core PCE, which the Fed watches, that's the indicator they watch. They don't really watch the CPI, just because of what's indicated in there, which I've gone over a million times in the podcast. But inflation over the past year is 2.6%. So he talks about the projections here, and while I expect the Fed will soften language, okay, that's what we've been talking about. They soften the language. They're not, they're talking about rate cuts coming and things like that, but they're focused on unemployment. They've been telling us that more than inflation, which is, an older model, old and slow, like, we always say the Fed. But the softer language, a cut in September, the risk of waiting are rising. Another ex-Fed member, first Lisa Aberkritz, first Bill Dudley, now Alan Blinder, former Fed officials are increasingly lobbying for the central bank to cut rates Wednesday. While the stars look to be aligned for a September rate cut because they don't meet in August, why wait? She says. Okay, there's still time for a July 31st cut. Okay, so people are talking, as they say, and the messaging is getting clearer that we're heading into all this. So, right now, we see that mortgage rates started the week at 6-month lows. That's a great indicator. Again, everybody's kind of heading in this direction. And again, we saw this earlier in the year, right? Beginning of the year, everybody had high hopes. The rates were actually at 6.6%. And then, we had higher rates and they kind of fizzled out. Well, we got the 10-year down, okay, 10-year treasury down. That affects our rates. And those are kind of a quick look at the national averages. And again, if you go with a mortgage broker, like we like to work with, you can get lower rates than what you see here and on the news and all that. Okay, so Redfin reports typical home buyer monthly payment drops to the lowest level in 4 months. Why? Rates and some price adjustments, of course, but the typical home buyer monthly payment was during the 4 weeks ending in July, 2671, the lowest level in 4 months, and down $166 from the record high set at the end of April. That's according to a report from Redfin Technology Real Estate Brokerage. So we're seeing that, even though that's happened, it hasn't quite gotten buyers back in the market yet. But keep in mind, as we go on this, for about every 100 basis point drop or 1% drop in mortgage rate, we will see that, or we know that 5 million more people could, not that they will, but could enter the market. So there's a lot of potential. We know there's a lot of pent up demand out there. There's a lot of people that want to move, homes haven't sold, or first time home buyers that felt like they couldn't afford it, or definitely couldn't afford it, couldn't qualify for what they want. But this is what's happening now. The sales to list price ratio is got us at, let's see, 97.5% right now. So usually we like to see that a little over 98%, but that's not horrible. Okay. So but there is a slight adjustment there right now while we're dealing with these higher rates. Okay. The other thing that keep in mind again, people are wondering, but the Chris, what about a crash? Could there be a crash? We're at 17,000. We've been kind of hovering around 17, 18,000 for total active inventory, all property types, all price ranges in the greater Phoenix area and across the country. There again, about, let's see, what is it? Let's see, brand new homes available or startups at 1.35. We were saying before, we'd like to see about a 4-month supply across the country and about 1.5 million in new starts. Well, this pretty much puts us right there or in that direction, where before we were like hovering around a little over a million. It's gone up a little bit. Now during the crash, where were we? But Chris, what about, does that mean we're going to have too much? No, just things are moving a little bit slower. We're in more of a balanced market now across the country and in the greater Phoenix area. So again, with context, during the crash, that we had 4 million homes for sale across the country, and in the Phoenix area, we had about 58,000. Okay, so again, we had way too much inventory back then, overbuilt, uh, which led to poor lending practices, which was a big part of why we had this crash happen. With these people, that were quote unquote, getting these loans to buy one, two, three houses, and they couldn't afford it. So with that baked in, we're, between the lending practices and that inventory, we're just not seeing that. And then we're starting to shift with interest rates. So we're not gonna we're not feeling like that's happening. We're not seeing anything that indicates a crash. All right. So right now, though, in Greater Phoenix area, things are moving a little bit slower. We're definitely in what we would call a balanced market. We'll talk about that more in a second. But 108 days closed down market. Okay, that's closed down market. Your median is going to be about half that, and then your you know, under contract um, right now is running in. Let's see, last I looked was 35 days on market. We've got a 2.63 month supply. For us, all intents and purposes, that's pretty much close to a balanced market or in a balanced market. Absorption rate's gone up a little bit at 38%. Average list price is 742, and the average sales price is 534, um, which is an indicator that we have a lot of properties under that five and $600,000 mark. Most of the inventory is in that range. If you look at the percentages here in the middle of the page, we see the actives, the pendings, and the closed units are down. As far as our, bubble bros crowd that getting them clicks on YouTube and stuff, our short sales across the country are pretty much like this percentage wise. They had this thing, oh wow, this huge percentage, 300% rise in foreclosures. Yeah, but that was after the pandemic. It's kind of like all these new jobs we have. Yeah, that was after the pandemic when people weren't working and things were shut down. Same thing with these foreclosures. So you can't go by percentages usually. You have to look at, well, what's the context? What are the actual numbers? And we see short sales are down, lender owned REOs are down, HUDs are flat. So, that's an indicator, 52, there's not even 100 properties in the MLS out of like 18,000 that are distressed. So yeah, we don't have a foreclosure crisis in the Phoenix area, and the same thing would be true across the country. Uh, yeah, so pending's down, closed units are down. So everything's kind of down across the board. Now, some of that's seasonal for us in the Phoenix area because, now that we're in the hotter months, we're getting into almost, might as well say we're into August just about here, and school starts back up in about a week or two for most people. So, that's something that's kind of seasonal for us. So after Labor Day, we'll see probably a little bit of a normal rush that we normally have, especially when we get into some of our retirement communities where people are coming in from out of state. Uh, and our winter visitors that like to get out of the snow, we'll see a pickup there too. But yeah, this is for us kind of seasonal anyway, so nothing crazy going on if you kind of look at it. Every year for us, school lets out, everybody wants to move, and schools lets out, and May they want to be into their property, go on vacation, get out of the heat, or enjoy the pool, and then they're back to school back to work and all that. So Crawford Market Index, this index basically means that anything under 90 on the index is a buyer's market, anything over 110 is a seller's market. 100 being dead center balance. Guess what? We're at 99.7. I'd say we are in a balanced market for the greater Phoenix area. When these two numbers of the demand and supply are the same, which basically they are, we have a balanced market. So demand would be down from that 100 mark as far as demand goes. It's down 26 on the index, okay, lower than it should be. And our supply is also down, which helps kind of mitigate that. That supply is also down 26. And so you got to remember too, truly new inventory is typically new home builds, because when somebody buys, if somebody sells a house, they're probably most of the time buying a house. As a matter of fact, in our area, it's typically about 15 to 20% of the homes that are sold are going to be investment properties. And even there, investors sell, buy another one. Okay. So the true new inventory for across the country and for the greater Phoenix area would be new builds. Just keep that in mind too, when we say new inventory, but it's all about supply and demand, right, guys? And what's affecting the supply is the builders are only going to build what they can sell without overbuilding like they did during the crash. And they're not going to overbuild it, not the March of Dimes, but we really need more supply, true new supply, to really eventually lower or mitigate the price increases that we've been seeing over the last couple of years. Okay. And that goes for everything: lumber, windows, appliances, right? The cost of everything. Part of that is energy. It costs so much to ship things, to move things around, to build these things with power, right? With energy. And that in turn raises the price of everything. Energy is a big piece of that, along with supply chains and all that, of course, too. So supply and demand from start to finish, guys. It does it all. As far as the individual cities proper in the greater Phoenix area, right now we're seeing Chandler still topping the list, but dropping 13% in a seller's market, but still in a seller's market. Avondale, Fountain Hills, Phoenix, Mesa, Scottsdale, Glendale, and Gilbert, Tempe. Those are all in sellers markets, but nothing crazy, guys. Nothing crazy at all. As a matter of fact, about half of those, more than half of those, are actually dropping a little bit. Okay, again, part of it's seasonal, part of it's the rates, right? People need to see those lower rates. Although, again, most people aren't really getting the whole message that you can get lower rates now, like I talked about earlier. Peoria, Paradise Valley, those are in balanced markets. Surprise, Goodyear, Cave Creek, Queen Creek, Maricopa City, and Buckeye are all in buyers markets. So that's basically it. And then if we look at our contract ratios, it really tell us the now, what's happening in the now. Where's our hotter and colder markets in the greater Phoenix area. And if we look at those areas shaded on our map here, we can see that, Chandler, Gilbert still have a couple of spots, along with South Phoenix, Levine, a little bit of Tolleson, a little bit of Peoria, a little bit of Glendale, and that's really it. Those are the only hot market, and those are just small little slivers of areas in those areas that I just mentioned. The rest of those areas are either warm or cold or very cold. Okay. So again, part of it's seasonal, rates, affordability, all that factors in, of course. Let's see if I had anything else for you. I think that that's really it. Again, we're going to watch the PCE is important. They're probably going to mention that. They're going to talk about that. We had good news on that last time. We'll probably have good news on that again. Also, we saw one other thing that they did mention that happened recently in the data was that people You're making too much money out there. The increase in people's pay, although a lot of people are working 2 and 3 jobs, part-time jobs, all that. A lot of the jobs that were available were adjusted. Some of those were not actually jobs after they did the adjustments in the labor data the last time. A lot of it were people who were coming in from other countries to do labor type work and things like that. So that was in case. So what we're seeing for the actual labor data is softening for Americans here in the United States. Um, and a lot of people are having to work multiple jobs, part-time jobs, all those sorts of things to make it in this economy. It is a tough economy, but uh, you know, uh, they have been very restrictive up to this point. Hopefully, they loosen things up this week a little bit, but probably by September we'll really start to see them with the numbers. But again, keep in mind a lot of that's already baked in, guys. So let's talk about your options that we have for whether you're looking to buy and sell, whatever the case may be. We have solutions for all of it that'll make sense, even if you've already tried to sell or buy here recently or in the past and thought, geez, this is just too hard, too expensive, not making sense. There's nothing out there, whatever the case may be. um, you know, I think we'll have a solution for you that'll work and it'll make sense. So, guys, reach out to us anytime. We'd love to be able to talk to you about it. Check the links below and feel free to reach out to us anytime. And we will talk to you guys next time.